favorite vendors at the LA County Real Estate Investors Expo to talk about what are some ways that owners of primary residence property that may otherwise have a taxable event, what are ways that they can defer those taxes? Lyndon, thanks for joining us today.
Thanks for having me, Bill. Appreciate it. And happy Thanksgiving week to you.
Thank you. And I know this is a area that you work on quite a bit. We've talked in the past about structured settlements as a alternative to 1031s. And I have to say, as a real estate agent, 1031s are one of those things that sound great in theory, but in practice are very difficult because you have such tight restraints on the investments that are allowed and the time frame to get it locked up. It just, in my experience as an agent, it almost never works out. I heard Grant Cardone, one of my favorite coaches in real estate, say he doesn't do it because it's never worked for him. So, Linda, I appreciate you bringing us some alternatives today. Just real quick, some housekeeping I want to share with you guys. This is the LA County Real Estate Investors Association official podcast. We do this every Tuesday, 3 p.m. Pacific time, 6 p.m. Eastern. We live stream it on YouTube, Facebook, and LinkedIn. And you go to lareic.com to get all of our content. We do a monthly event that's free in LA in the Palms area at the Iman Center. We have about 250 people. We usually have a great speaker. We have a vendors table as well, about 50 people. I'm one of them. Love to see you there. And then we have a vendors expo you can sign up for free and the speaker for free. So December 14th is upcoming, Out of State Investing Summit. Click here to sign. It's free, if I didn't mention that. Free parking if you get there in time. And so you get a great presentation. You'll see vendors like Lyndon and me there as well. So Lynn, let's talk a little bit about structured investments on sales.
Indeed. Hi, everyone. Thanks again for joining. Just to set back for a second on the 1031 that you spoke about, many of you might have seen me or heard me in the past. We've spoken on the DST 1031, which helps to eliminate that stress of finding a property in 45 days. And we've talked on opportunity zones. Well, oftentimes I get the question, oh, what about my primary residence or my the sale of my business? How do I defer taxes there? Well, one tool that's in the tax code is the structured installment. You can utilize a structured installment to defer, reduce your tax liability over time. This tool is utilized quite a bit in the legal world. When there's a settlement for wrongful termination, wrongful debt, those kind of things, discrimination, sexual harassment, those kind of things, they are taxable settlements. So if someone gets a $2 million settlement for wrongful termination, like I had a year or several months ago for a United Airline pilot, the wrongful termination, he won $2 million, but if that $2 million hits his bank account right away, all of a sudden it catapults him to the 1% of earners in the state of California. So now you're looking at a 37% federal tax hit because he's in the top bracket. And then you're looking at 13.3 in California, he's in the top bracket. So that 2 million, all of a sudden, come April, he has a 1 million tax liability. So how do you massage that, reduce that liability? You structure it. You don't need the 2 million right away. You say, you know what, pay that 2 million out over the next 5 years, 10 years, 15 years, etc. So for that situation, we structured it. He wanted to have about 8 to 10,000 monthly. And we said, okay, let's structure that for 15 years out. That was what he felt comfortable with. And the client is in charge. They make the decision how they would like it structured. So we drafted a contract with MetLife. And all it is a fixed annuity. Nothing, no bells and whistles. You're not exposed to the market, etc. You just have a straight annuity, earning an interest of anywhere from 3 to 5, depending on the length of time you defer. And that money continues to grow and build. And now you control the cash flow. So you only tax on the dollars you receive in the year you receive it. That way you basically manage your tax liability as opposed to 2 million hit in his bank account. And then bam, he's all of a sudden the 1% of earners and 1 million goes to the tax man. So you spread it out and you earn interest on that, because the reality of it is the 2 million hits your bank account or 3 million or whatever, and you pay the tax, and whatever's left over, now you're looking for a return on those dollars. You're looking for a CD return or treasury bills or whatever. So why get to that position? Let it stay sheltered and earn the return you would be seeking after the tax was paid. So earn the return before the tax, 3, 4, 5%, and let that grow. So that's kind of how the structure can fit when there's a sale of a primary residence, low cost basis primary residence, or the sale of a business. Mom and dad built a business, they got an offer for 10, 12 million for that sale of that business. If 10, 12 million hits their checking account or after the escrow closes, it's a major tax liability. You say, you know what, send us 3 million of that 10 million. We're going to structure the remaining 7. We have grown kids and grandkids. Let's strategize and structure that out into the future and have that earn some interest deferred along the way.
I sold a business a long time ago, not for 10 million, for a much smaller amount, but it represented about 3 or 4 years income that we deferred. We built the business and took it all. And I remember I was talking to my accountant and I said, well, we'll just take it all now. We'll pay the taxes. It was a higher rate. And then we made a decision like in December. In January, the government passed a retroactive surcharge on incomes over 250 time because you were rich. Well, that money was really a sale of a business. It wasn't that I was making that kind of income annually.
Exactly.
It was a one-time thing that represented 4 more years of hard work. And so on top of the higher tax rate, we paid an extra 10% on just that extra money. It was just unbelievable how, and from that point on, I've been much more careful about learning about tax strategies. One of the things I'm sure you get a little pushback is, well, I'm only going to get 3 or 5% on my money. If I invest my money in this Bitcoin strategy, I'm going to get 25% per month. Why would I settle for 3 or 5% return on investment when there's so many other attractive alternatives out there? How would you answer that?
Well, I'll answer that by saying this. Every time you make a dollar that's outside of an umbrella of a tax shelter, Uncle Sam wants 30, 40 cents of that dollar in terms of taxes. So by having money stay under the umbrella of tax deferral, you're actually 2 steps ahead in terms of building wealth, because the tax man doesn't take a piece of that until you decide when you wish to take it. So people always say, yes, I can put that money, pay the tax, I'll put it in stocks and so on. But as you know, those things are not guaranteed. They're not, it's not a sure thing. You will have some volatility like we've had through the markets here this last year. Right. So clients who are not comfortable with that volatility, it might sound good at first. They want to go in and own those aggressive stocks and so forth. And then as soon as the volatility happens, they're forced to sell because they're doing it themselves. It's not professionally managed and so on. Right. And even if it was professionally managed, they're still really nervous about it. And they're calling their advisor, gee, should we sell that? I can't stomach these statements. I'm losing. So that basically, the structure allows for none of that. You're basically getting a fixed annuity that's going to pay you a nice return and give you some assurances that you will earn a tax deferred interest on those dollars, and then also grow that principal safely as well, and gives you a predictable pension pretty much, because you're using the equity that was in your house or your business, and you're creating your own personal pension to pay you over the next decade, 15 years, etc.
And one of the other advantages, I think, is by spreading the money out, you might be at a lower tax rate, because when you get over a certain number, Uncle Sam and Uncle Gavin Newsom are more aggressive. And if you're below those thresholds, you'll avoid some of those higher surcharges and higher costs. And so it allows you to manage your income appropriately over time. Now, the money that's going into the structured settlement, does that count as income to me, I guess, in terms of, I guess, estate planning and social security and all those kinds of things? I imagine it's mine in a sense, but it's not really mine. How does that get computed into income calculations?
Well, it is yours, but it's not counted as income until you start to receive it. So the 2 million that you might have gotten in a settlement is deferred by using a fixed annuity that MetLife has issued. So the monies are paid to MetLife for benefit of
Got
that
it.
individual. So
So you,
MetLife has that contract that you and MetLife and myself have consulted on, and what kind of cash flow monthly would you like, or quarterly or annually, that's comfortable for you. Once you give us those numbers, we put them in a contract with MetLife. They draft it up, and then they say, okay, we'll pay you another 3.5, 4.25 on those dollars based on the time that you've allowed to defer. It warrants that kind of return. So now your contract says you want 100,000 annually or 125 annually. So that's when you would get 1099 on
got it.
just those dollars on an annual basis. So rather than getting 1099 and 2 million, which will, like I said earlier, will put you right in the top bracket of earners, and 1 million goes to taxes. Now you're getting taxed on 125. You're much lower in the lower bracket now, and that's a manageable tax consequence. And then the remaining dollars are continuing to earn a tax deferred interest.
These are very complicated matters, and I don't think our goal today is to help educate people how to do this on your own. I think our goal today is to get you to raise your hand and say, maybe this is a solution I should talk about. I need to find out somebody can help me. Is that person you, Lyndon, or how does somebody go from I have this large distribution coming, either sell my house or business or whatever, and what do I do with it? Is that a consult with you? What's the next step? Typically?
Yes, that would start with a conversation with someone like myself. I'm a financial advisor. I have my insurance license. I have my Series 7 licenses and so on. So an insurance license allows me to consult on this in this area. And then I team up with great best-in-class providers who this is what they do. The MetLifes of the world, they structure millions and billions of dollars and have billions of dollars in fixed index annuities and fixed annuities and all of those kind of things. So yes, they would consult with me. We would certainly go over some questions and what they are looking for and how we can best address their need and so on.
It also seems like you do presentations from time to time. Is that for professionals, or is that for prospective consumers who might be coming into this kind of money?
It would be prospective consumers as well, and a lot of like-minded people in the room who have a primary residence. Their grandkids are in another state. Their grown kids are in another state. They're here on the West Coast. They'd love to just pick up and go, but the tax liability, and they don't want to be a landlord managing an asset in another state and have the headaches that can come with that. So they're kind of reluctant, but this can be a tool that can allow them to free up that asset, take a smaller dollar amount, buy a condo or a smaller house, downsize close to their extended family, and then structure the remainder over the exemption, the 500,000 exemption. So you can pocket your 500,000 exemption for husband and wife. And then any remainder, you can structure that and have your own personal pension. That money hits your bank account on a monthly basis, like a pension from a corporation or something.
Oh, great. Well, Lyndon, if someone wanted to get a hold of you, what's the best way to get more information with you?
310-954-8384. There's a couple of attachments, if you can bring one of them up, that shows a structure for a 10-year and a 20-year. This is a nice brochure that talks about the first one was a nice brochure that talks about the structure and the procedures that you would go through to have it structured. And then the other attachment shows let's see here. Yeah, it shows a 2 million structure, and 2 million, this is a 10-year structure. 2 million basically turns into 2,386,000 is what it looks like there.
Mm-hmm.
And this is 3.65 interest. This illustration was drafted early in the year, so the rates are probably much better now than back in January. Go to the next 20-year structure, and you can see the 20-year structure. The client is getting 12,166 on a monthly basis, and that 20-year structure actually grows to makes the 2 million grow to 2,919,000 over the course of that 20 years with a return of 4.12. So, and the cost there, you will see the 750 to draft the contract. So this is not a managed account. They're not charging a 1% management fee or anything like that. It's a simple annuity contract fee to draft the contract, and then those dollars are coming to you based on the terms of the contract.
And it's also important to note that you don't have to put, as you mentioned earlier, you don't have to decide to put everything into this structure, just the amount that you want to have structured over time. So if you sold a business or a primary residence for $10 million, you might put, 10 million, 8 million, 6 million, 3 million, 2 million, whatever works for you as part of your plan into a structure like this. And the rest you could take and pay taxes on in any other format that you wanted to do it.
Exactly. It's their money. It's their decision. Whatever they feel comfortable with, they can retain 2 million of that 10 or 5 million of that 10, pay tax on that, and structure the remainder. The bottom line is monies need discipline because when 5 million hits your bank account, everyone needs a loan, all your relatives need a loan, etc. And now monies are leaving and you didn't account for that. And then the money is there in a money market in the bank with no discipline. It's cash, and you can easily get to it, or you easily be talked into some other deal, etc. And then it's seeking a return as well. So with the structure, it gives some discipline to a portion of those dollars where they're not liquid, they're not to be touched. That's my monies that are coming to me. That's my pension. And that's a monthly dollar amount that's hitting my checking account, and it gives it some discipline. It earns a tax deferred growth, and it's a major benefit in terms of reducing your tax liability, deferring that tax liability, etc.
So I'm going to put a link to these documents in the description down below. If you're watching this on the YouTube or Facebook or LinkedIn, you'll see it down below. You can reach out to Lyndon, get updated versions and personalized versions as well. And again, Lyndon, one more time, your phone number is
310-954-8384. I'm in West Los Angeles, in Brentwood, Wilshire, and Centinela, to be exact. And I service all of Southern California, people in other states I service as well.
And you also come to the LA County Real Estate Investors Association meeting, which,
Indeed.
Since we brought that up, LAREIC.com. It's the second Thursday every month. 50 great vendors, of which Lyndon is just one of them. He's one of our favorite, but there's 49 others that you can learn from and grow from. And we'll have about 250 people who come to the class and learn about real estate. There's education going on there. There's community as well as mentorship. And there's a vendor fair as well that starts beforehand. And that goes on for about an hour. 50 vendors. Lyndon's one. I'm one. Love to have you join us there. So you can go to LAREIC.com, sign up for the Vendors Fair program. It's free. Second Thursday of the month, December 14th, upcoming here in the Palms area of Los Angeles. And this topic will be Out of State Investing Summit. Love to see you there. If you saw this podcast, come up and say hi to me, come up and say hi to Lyndon, and we would be more glad to answer any questions or sign autographs if it's appropriate. Lyndon, as always, thank you for your time explaining these complicated programs and making yourself available to our customers. I appreciate your time.
My pleasure. Anytime. Thank you.
And again, we do this live on Tuesdays at 3 p.m. Pacific time, 6 p.m. Eastern. Love to see you join us. We're also in the Facebook group. We have a Facebook group for the LA Investors Real Estate Association. Love to have you participate there as well. I'm Bill Gross, outbill gross probate. As always, make today your best day ever. Thanks so much.